Hi, I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree.
And I'm Jeff Weniger, Head of Equity Strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets.
Hey everybody, welcome back to Minds on the Markets here. Certainly a lot going on as we enter the fourth quarter. Here we are, right? Q4, Jeff, only 3 months left in calendar year 2025. And, it's interesting. Obviously, a lot of the focus has been on the Fed resuming rate cuts. But, it's interesting. The decision seems to be made just focusing on some of the disappointing numbers we saw in non-farm payrolls. But what say you about the rest of the economy? Are we missing something?
Yeah, we're missing all the good news. And look, I as we pointed out in the written piece over there on the Wisdom Tree website, look, you could always point to bad headlines or scary things. Anytime you use the S word, which is subprime, right? The subprime auto lender just went kaput a week or two ago. And you don't want to see that type of thing in the economy. And you have the reality that we're still here, as you point out, the kids are going to be trick-or-treating soon. There's still a lot of international trade deals not signed, and you don't want to see these things. But compared to a lot of what we've been through last 10, 15, 20 years, Kevin, these rolling headlines are not half bad. I mean, just a year ago, we had Yen-mageddon. We did the Grexit saga where Greece was going to theoretically leave the Eurozone. That ran for 3 or 4 years. We had to worry about that. Brexit itself, COVID lockdowns, supply chain issues. I mean, Kevin, you could probably name another 5 or 10 just in the last 10 or 15 years. This is not such bad news flow if you really think about it.
I mean, it's fascinating, right? How many years now we're going back since the end of this Fed rate hike cycle that the great prognosticators of the world, recession, and it's kind of, waiting, and it's still not here. But you're right. I mean, compared to what we have witnessed over the last decade or so, what we're experiencing now is kind of child's play. I mean, so, take us a little bit outside of non-farm payrolls, the unemployment rate. I mean, focus on that. What about what's going on with the nation's small businesses? What is the word on Main Street, not Wall Street?
Absolutely. And everyone, make sure you're liking, subscribing, following, doing all that fun stuff so we can build the channel here, of course. Okay, you said the unemployment rate. Well, first digit's a 4. I mean, this is one of these things where if you deteriorate the unemployment rate into 2026, all right, it's reasonable enough. 4.3 becomes 4.5, 4.7, 4.9, whatever the case may be. In markets, all that matters is whether or not you're surprising anyone. Is anybody going to be surprised if the unemployment rate backs up into the high 4s or into the 5s? That's basically base case in many minds. It's not anything that's a big surprise. And they made the big stink a couple of weeks ago over, there's more unemployed people in this country than job openings. Okay, well, we pulled the data, and that's the case 75% of the time. There's basically always more unemployed people than job openings. But that's the clickbait you start seeing over there on Twitter and that type of thing. And then if you mention small businesses, basically you take the NFIB survey, which is the National Federation of Independent Businesses. We pick that thing apart every time it comes out. There's a lot of great nuggets in there. And they ask, are business conditions going to be better 6 months from now or worse? And if you look at the gap between people who said better and people who said worse, it's an 80th percentile reading. In terms of 80th percentile to the good. A majority of small businesses relative to those who are pessimistic, the optimists are clearly outweighing them.
I mean, the Fed cuts rates here in a financial conditions kind of situation where financial conditions are not tight. But here we have, once again, as we're talking to all of you out here, a 10-year Treasury note just a little bit above 4%. So, final thought, housing. It's such a big part of the economy. You got now a 10-year Treasury yield at 4%. What is that doing to the 30-year mortgage rate?
Yeah, absolutely. And if you go ahead and like the channel, we'll have Kevin do some Fed criminology in a couple of weeks when we come back to this, if you go ahead and follow and subscribe. All right, so we're at, if you take a look at, for example, Mortgage News Daily of late, they're about 6 3/8 is where a conventional mortgage is in this country right now. Most people will point out that that will oftentimes follow the 10-year T-note, not the 30-year long bond, because people die, people move, people get divorced. You don't typically service a mortgage for 30 years. So if you continue to get a rally in fixed income, you could theoretically get something down in the fives on a mortgage rate. Maybe it's not 5.0, but maybe it's 5 3/4 or 5 7/8. And one of the things that's been critical that we've been pointing out, Kevin, and I don't know, you're the fixed income one guy, you're going to tell us where bond yields go. But if we get down there, say a 0.5 percentage point lower here in mortgage rates, you could start to see something like a refi boomlet occurring in this country. The Mortgage Bankers Association refi index is doing this. This is the official chart here, Kevin. That's the chart. It's going up. A lot of people got 7.5, 7 3/4, 8% mortgages in the last 24 months or so. Those people may refi. That could be a 2026 theme.
Well, I think that's an important way, perhaps to end this episode, is as we're in Q4, you're going to start seeing more and more outlooks for 2026, which of course Jeff and I will be opining on for sure. And to underscore Jeff's comments before, if you like what you're hearing here, please tell your family, tell your neighbors, tell your friends, get out and like us. And with that, have a great one, everybody.